Welcome to readtheticker.com. Today we're going to talk about stock options. When you review stock options, either to buy or sell or to do a strategy, the first three questions you must ask yourself: what is implied volatility? Implied volatility is a major component of the option premium price. The second question is: how tight or narrow is the bid-ask spread? Because the wider the spread, the more money goes to the market maker. You want a narrow spread. How liquid are the option? For example, you want a stock symbol where there's a large amount of volume and open interest traded on the option contract. To understand implied volatility, you have to understand historical volatility. Now you can freeze this video to read this in detail, but simply historical volatility is calculated by taking the underlying and doing a mathematical calculation of standard deviation going back a selected time frame. So it's based on the actual price, whereas an implied volatility is derived from the option price setting, and it's based on the traders willing to hit the bid or the ask price to send prices up. So it's basically talking about the implied volatility within the stock's future. It's on how the traders feel where the stock is going. Generally, implied volatility rise when the stock approaches earnings, because earnings might be forced the stock price up 20% or down 20%, and the implied volatility rises to offset that because they believe stock prices might move violently or with a higher volatility in the next 2 or 3 weeks after the earnings announcement. So therefore, they're two different animals. You've got implied volatility, which is based on the expectations of the immediate volatility to follow after an event or whatever may happen in the future. And you've got historical volatility, which is based on what's actually happened in price action. Implied volatility is motivated by traders buying and selling the bid and ask of an option contract. All right. A lot of people ask in the options game, when you're looking at premium prices, are the option premiums cheap or expensive? Implied volatility is a major factor of pricing an option premium. The generic answer to determine whether an option premium is expensive or cheap is to compare implied volatility at say 30% compared to historical volatility maybe at 20% over a period of time. But you've got to work out what time frame to consider it as, because historical volatility is over 20 days, 30 days, 60 days, or a year. So it's actually quite a difficult approach. In a sense, it's actually comparing apples and oranges, whereas readtheticker.com believe that the best way to compare whether an option is cheap or expensive is to compare implied volatility to previous readings of implied volatility. For example, the blue line is the plotting of implied volatility of the front month contract. It swings up and down. Generally, it's range bound. So over a period of time of either 6 or 12 months, you can determine whether implied volatility is at the upper range of the 6-month period or at the lower range of the 6-month period. So if you're at the upper range, if an implied volatility is at the upper range of the last 6 months, that means premiums are bound to be expensive and selling premium should be considered. If implied volatility is at the lower range of the 6-month or 12-month period, that means premiums are relatively cheap and buying strategies should be considered. For example, at the end here, you can actually do a calculation. You actually can work out the range of the previous 6 months. And if it's at the upper range, you might give it a 100% reading. And if it's at the lower range, you might give it a 0% reading. So I've given this tag at 20%. Let's show you on the website. Yeah, look at that. Oh, here we go. Okay, so here's Apple, and here's an implied volatility plot of the front month contract. Now, if I screen mark, that's what I'm after. The last 6 months is about here. So if I draw the upper range along there like that, that's the upper range reading of about 42%. And this will be the lower range the last 6 months. which is about 20%. You'll see that the current reading is at 20, which is closer to or near the lower range. So as I've got written over here, you'll see here that says that 6 month high is 45, the low is 25, the mid is 35, and the range position is 0%. So the current reading is around 0% for the 6 month reading of implied volatility. This would suggest that because implied volatility is quite low, premiums would be quite cheap. This event here, as you can see, Apple sold off, implied volatility skyrocketed. Obviously some news event, I don't think it was earnings, but I'm pretty sure this was earnings down here. This spike in implied volatility, that was earnings, and so was that, and so was that. When you have a upper range implied volatility, if you took option strategy which sold premium, the immediate effect of whatever the event that was taken into account, the drop in that implied volatility would mean immediate credit to your bank account, as premium prices would have plummeted. And obviously goes the same for buying premium. If you did an option contract here to buy premium, and price moved in your favor, then you're making money as implied volatility goes up. So if you took a contract here to say you went a long call here, right, and even though price went down, there's a good chance you probably would have still made money when it got to here, even though it's near the same, because implied volatility shot up. Okay. Now, as I discussed before, I mentioned we take this position here, range position, 0% for 6 months. We'd actually go to the swing scanner. Great. And we go to things in the NASDAQ. Yep, Apple's in the NASDAQ. So we go along here, you'll find that volatility implied position, the reading is 0%. The latest reading of implied volatility was 25, and the latest historical reading was 25. So therefore, the swing scanner lists the implied volatility range. And if I take my swing scanner to top option stocks have been identified as stocks which have good volume liquidity and open interest, and also a good spread. So what I go over to my swing scanner and I do a sort on implied volatility position. Okay, so everything above 62% implies it's the upper range of implied volatility, as discussed in the previous demonstration. So these symbols here, you'd be looking for sell strategies, and here is our trend measure. So if you wanted to do a credit spread or a debit spread to sell to collect premium, you'd be looking at where implied volatility is on the upper range. And if you're looking at situations where you wanted to do a buy premium, looking at implied volatility was at the lower range, taking into account trading measures and what have you like that. Also, within readtheticker.com, we have our where are we? Options. Options tool to determine probability. So here you can put your cone in when you do a trade to work out probability of where the strike prices should be. If you're doing a condor, or if you're doing a credit spread or a debit spread, you can work out where the strike price should be within the probability range. This all takes into account implied probability and also your bullish and bearish bias. So that's how you can take advantage of monitoring and using implied volatility to sell or buy options within readtheticker.com. Thanks for watching.